Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back again for our weekly edition of That's Our Two Satoshis Live, where we talk about everything happening in the digital asset market. Usually coincides with the blog that we write, which if you're more of a reader, you can find on our website, ar.ca/blog. I've been doing this for about 6 years. I can tell you it's just as exciting now as it was 6 years ago. Just a lot of stuff going on at all times in the crypto world. We tend to focus specifically on what's happening in the capital markets affecting prices. So, as always, this is not investment advice, but a couple things that were interesting to me this week. First and foremost, the sell-off. Obviously, not the biggest sell-off. I think those of us who have been in the digital asset market for a while, we're more accustomed to kind of big, huge liquidations where you see a lot of future liquidations cascading, generate pretty eventful price action. This started, last week on Friday after we had the NFP report. I know it's kind of boring to talk about macro all the time with crypto, but in lieu of other specific crypto news, macro does tend to take hold. And what was interesting about this one, though, is you had the NFP report on Friday. It was sort of mixed. Certainly had an effect on rates. I think rates went about 12 basis points higher on the day. You saw gold start to rally. Typical inflation signals after the NFP report. What was interesting, though, is usually when you have a sell-off from macro standpoint, you usually see it affect Bitcoin and ETH more than everything else because those are the assets that the macro guys are trading. What was interesting was that Bitcoin and ETH only fell, call it what, 2, 3, 4% at most, while you had alts fall in the 15 to 20% range. Some pretty big moves lower. And this is what happens when you get into the summer, when you get periods of low liquidity. I think the market is still having issues post-FTX, post-Alameda, with regard to market makers and liquidity, especially as we just keep growing the number of tokens that are out there. So it was really kind of an odd sell-off because of how uneven it was. But it does sort of fit with the theme that we've seen this year, which has been, even though we are broadly higher this year, most tokens are not. This has been a very uneven year-to-date rally, very similar to the equity market, where you look at things like the S&P 500 ratio relative to the Russell 2000, because of strength and things like NVIDIA, and some of the other of the Magnificent Seven really propping up the entire market. You have this real, low breadth and uneven distribution of returns. The same thing is happening in digital assets, and we saw it on the downside last week as well. What was more interesting was just, we've had about 16 consecutive days of inflows into the Bitcoin ETF. And there's some nuance there because we've also seen record shorts in Bitcoin futures on the CME, which suggests that a lot of this is just a cash and carry trade or a basis trade where you buy spot via the ETF and you short futures at a higher price and just lock in that yield. But still, having that many consecutive days of inflows, we've only seen that one other time, a streak that long, and that was early in the ETF's lifespan, back from January 26th to February 20th. And that was a time, basically similar flows. You had 3.6 billion of inflows in this last week versus 4.4 billion of inflows during that January to February stretch. But Bitcoin went up about 30% during that time, and really only went up about 15% this time. So definitely a little bit of a muted rally relative to the flows, but may be why Bitcoin outperformed on the way down when you saw that liquidity sell-off. So again, heading into this week, we'll see what happens tomorrow with the FOMC. I don't think anybody is expecting any sort of deviation from the plan from Powell and the rest of the Fed. I think it's been pretty well illustrated at this point that the next move is going to be a rate cut. We just don't know when. We did have the Bank of England as well as the ECB, the Bank of Canada and the ECB come out with rate cuts. So you'd expect at some point the Fed will follow suit, but there's really no impetus and no reason to, with equities at all-time highs and no real issues on the horizon right now. I'd expect you to start to see rate cuts maybe closer when we get to the election. But what's interesting about the FOMC tomorrow is that there's been 4 of these FOMC meetings in 2024. And every one of them, we've seen a pretty big sell-off of digital assets right before the FOMC meeting. And then in the next couple of days after FOMC, it's retraced. So we'll see if the move that we saw on Friday of last week, as well as continuing last night and into today, we'll see if that retraces when we get the FOMC meeting tomorrow as well. Away from that, though, again, it hasn't been a real strong period of time for the broader market outside of some of the majors. But it'll be interesting to see if some of these regional bank stressors start to creep its way back into the market. So the reason I'm bringing this up is that in its quarterly banking profile, the FDIC said that banks now have more than $500 billion in paper losses on their balance sheets, and 63 banks would be on the brink of insolvency if they're forced to realize some of those losses. So, this all started obviously in 2022 when the Fed started to raise rates. You start to have all kinds of net interest margins for banks where they're lending long term but borrowing short term, and when short term rates start to go up, but they've already locked in their long term lending at lower rates, they start to have very negative mark to market. Of course, banks don't have to realize those losses, they can hold them to maturity. There's only two reasons why a bank would really suffer from that. And that's what we saw in March of 2023. So, one is that your customers flee. If all your customers start to leave, well, if you have long dated liabilities and short dated assets, long dated assets and short dated liabilities, then you get into a duration mismatch and you have to file for bankruptcy, which is again what we saw in March with Silvergate and Signature Bank and Silicon Valley Bank. Or two is that your equity holders just give up on you and start to dump their shares, which is what we saw with Republic First earlier this year. So it's not a guarantee that you're going to start to see real bank issues from this, but it's a reminder that if you go back to March of 2023, people were scared. Even though the Fed and the Treasury and the FDIC stepped up very quickly to guarantee depositors and here in the U.S. and make sure that customers didn't face losses, there was still real fear. And I'm not just from the equity markets, but from customers of these banks. I personally fielded 4 phone calls during that time from small business owners just asking me, like, am I going to get my money out when the bank opens on Monday? Am I going to be able to pay my employees or my vendors? And it really did spark a conversation about bearer assets, right? What does it mean to actually own your own assets, like in a non-custodial wallet, like a Bitcoin or even a stable coin, versus when you own it at a bank or with a government where it's not really your asset, it's the liability of that bank or government, and it's their choice of whether or not they give it back to you. So, March 2023 was a good advertisement for crypto and helping people understand that you don't really necessarily own all of the assets you think you do. Here in the U.S., maybe you feel a little safer because, historically the government has been pretty lenient about that to make sure customers don't face losses. But outside of the U.S. and other countries, they certainly don't feel that way. They know the value of bearer assets. And these are real risks. Even though, again, there's no real near-term impetus for why customers would flee these banks or why equity holders would dump their shares, it could happen at a moment's notice. That's the nuance of online banking and equity trading is that, you don't have to go into a branch anymore and get your money out. You can do it in an instant online. You can sell your shares in an instant. So it's a non-zero risk, and the market is pricing it in like it is a zero risk. But I think that's, just another reminder when you see the graph that we put into the blog about how big $500 billion is and how big these unrealized losses are on banks' balance sheets. This could definitely, rear its ugly head again. And I'm not suggesting that we're going to see failures per se, but we could certainly see a little bit of a bid to bearer assets like digital assets if you start to see that fear substantiate further. So, we'll see what happens this week with the FOMC. We'll see if any of these regional bank reports start to get some legs. Otherwise, I think more so than not, the second quarter has really just been kind of a chop. We've been chopping in ranges. There hasn't been a lot of real crypto-specific news outside of the Ethereum ETF. And we'll see if we get a little bit of a bounce back from this. I'd say another thing to keep an eye on would just be the Ethereum ETF announcement itself. We do expect comments on the S1s to come back sometime in the next few weeks. And certainly if we can get an Ethereum ETF launched here over the summer or into the third quarter, it'll be yet another spark of demand and fund flows into the space, which I think we all need right now. So that's it for this week. I'd encourage you guys to check out the blog and look at some of the charts and look at some more of the details there. But we'll be back again next week. Thanks for listening, everyone. Take care.